Hey guys, welcome back. Long time no here. Today's topic is extremely interesting. We will speak about how to boost your annual returns by selling put and call options. I know when most of the people hears for options, they think about Reddit crowd, speculators, and gambling. But actually, options have an extremely important role in investing. You can use them as a insurance. There are very safe way of using options, although options are still extremely volatile and risky investment class, and you should be very cautious and do your due diligence before investing. But today I will explain to you how am I doing it. I will explain to you what are options, in which cases I am selling them, what is the worst case scenario that can happen, and I will use charts to explain to you exactly how time and strike price of options dictates my returns. And by visualizing everything, I hope that everything will be extremely simplified to you and that you will understand everything. But before we move on, you can see my portfolio is still performing a little bit better than S&P 500. I have been funding it heavily, so that is why it crossed $62,000. I was buying a lot of stuff, but I will disclose to you what exactly have I bought in some other video. For now, let's just move on to today's topic. So what are stock options? Well, stock option gives an investor or to a buyer the right, but not the obligation, to buy or sell stock at an agreed price and during some time period. In practice, how does it look like? Well, for example, you can see here, I have sold 2 put options of Dropbox. Extremely important thing to know is that I do own stocks of Dropbox. I own 500 stocks of Dropbox right now, and I have sold 2 put options. As you can see here, they have a time period. They are worth until April 16th. And the strike price is this last number. For a first option, it's $19. For a second one, it's $20. And I received approximately $100 for each one of those. So in total, approximately $200 for these 2 options, which I have sold. But if you are confused, let me explain this to you on this chart. As you can see, price of Dropbox right now is at approximately $23.50. So if in the next several weeks, until the April of 16, stock of a Dropbox will be priced above $19 or above $20 in case of a first option, because they have different strike price. Those options will expire completely worthless for a buyer. And for me as a seller, I will be able to keep those $200 which I have received. So that is basically the best case scenario. If stock price of a Dropbox stays above $20 in next several weeks, I will receive $200 for basically for nothing, or for giving a buyer opportunity that the next several weeks he will be able to sell me those stocks, 100 shares of a Dropbox, for $19 and $20. Of course, his price of a stocks will be above that price. He won't do that. Why would he? Because he will be able to sell it on the market for higher price. So what is worst case scenario here is that, for example, price of a Dropbox goes down to $16 or $15. In that case, I will have to buy 100 shares of Dropbox for $19 and $20, when price on a market will be at around $15 or $16. Also bear in mind that I have received $100 for every option that we are speaking here. So realistically, I would have to buy 100 shares of a Dropbox at $19, but also I would have received $100. So realistically, my price would actually be $18. Again, worst case scenario would be that price of a Dropbox stock completely crashes. So why am I doing this right now? Well, I'm selling put options in case where, number one, I have cash on my hand, that in case of a real crash of a price of a stock, in this case Dropbox, I am able to buy it without going into the margin or something like that. And in second case, if I know that Dropbox realistically is worth at least $25, $26 right now, I am quite confident that price of a Dropbox won't crash so low. So with high certainty, I know that this option will expire completely worthless. But then again, if it for some reason doesn't expire worthless, and if I will be forced to buy 100 shares of Dropbox for $18, that won't be end of the world for me, even though that would be worst case scenario, because I do know Dropbox is a great company and it will eventually be priced much higher. So hopefully you understand why am I doing this and how am I generating additional income and basically return on my portfolio by selling put options. So I'm doing that in a case that, for example, company that I'm looking to buy is right now priced, for example, realistically or even a little bit overpriced, like many tech companies right now are. So instead of buying overpriced stock, I can simply sell put options at lower price. So if that stop continues being overpriced, unrealistically priced, that option will expire worthless and I will be able to generate some additional income. And if stock actually crashes on some level that is appealing to me to start accumulating them, for example on some price where they will be undervalued, then that option will be exercised and I will receive those stocks at a price which I find that they are undervalued. And again, I will also show you in which cases I'm selling call options. So I will mostly be selling call options for a value stocks, like for example Walgreens. As you know, I also own Walgreens stocks. It is extremely important that you own stocks whose call options you are selling, because if you don't own it and price of a stock skyrockets, you can lose a lot of money. But if you own underlying stocks whose options you are selling, you will do okay. So I will tell you when am I doing this, what is worst case scenario, what is best case scenario, and I will show it to you on a chart. You can see that, for example, I have sold 2 options for Walgreens. One actually have expired on last Friday. You can see that this date is in past. And second one will expire this Friday. Both of these call options have strike price of $50. I will show it to you soon on a chart how does it look like. And again, I have sold in this case call option. In this case, if buyer of a option wants, he can force me to sell him stocks at certain price. In case of a put options, he can force me to buy stocks at a certain price from him, but in this case, he can force me to sell him stocks on a certain price. So in this case, you can see here that option number 1, which expired on last Friday, had to reach $50 in order for me to lose my 100 shares of Walgreens, and I would receive $5,000 for 100 shares of Walgreens. And as you all know, price of Walgreens stocks is right now at $47-48. So that option expired completely worthless for a buyer, and I kept my $50 or $60 for which I have sold the buyer this right. And option number 2 will expire actually this Friday. And again, if Walgreens stock price doesn't hit $50 until the end of this week, those options will also expire completely worthless for a buyer. And I will also be able to keep those $50 or $60 that I have received for this option. So when am I selling call options? First of all, I am selling them for companies that are not undervalued anymore. If you remember, I bought Walgreens stocks when they were trading at around $40. And at those prices, they were really undervalued and I had no any intentions of selling them. But right now, they are trading at almost $50 and I feel that they are fairly valued. I don't feel they are overvalued. They still have decent dividend. They are really good company and I'm not in a hurry of selling them. But at this price, I will start selling call options. So in case that the price of Walgreens stocks keeps going up to $48, $49, $50, $52, my options will be exercised and I will sell my Walgreens stocks for $50 per stock. Otherwise, those options will expire worthless and I will keep cash. And when those options expire worthless, I will simply sell another options for next 1 or 2 weeks. Strike price which Walgreens stocks have to achieve in order for them to be exercised, in order for buyer to take my stocks, let's put it that way, is always approximately 2, 3 or 4% above current market price. So the worst case scenario in this situation is that Walgreens price skyrocket on the stock market, and in that case I will be only able to sell them for $50, even though, for example, their price might be $55. And of course I would collect premium for a stock that I have sold. But since this is value stocks, they rarely move 4, 5, 6 or 10% on a weekly basis. So I'm quite certain that I will be able to sell call options on Walgreens stocks for a long period of time. And if, for example, I will be able to sell call options on Walgreens stocks, for example, 2 times a month, I will be able to receive 1 or 2% on them every single month, only by selling call options. So if you add to that some dividend which I'm receiving for this company, and if you add to that a little bit increase in stock price, perhaps I will be able to generate more than 20% of return on this stable value stock like Walgreens. Why I am not going to do that on a tech companies, for example like Facebook, is because I feel that Facebook is really undervalued. And even if I would sell a stock option at a strike price which is 5 or 6% above current market price, I wouldn't feel comfortable, because even if Facebook, for example, would be trading at $300 right now, I would still feel that it's undervalued. But if, for some example, stock of Facebook would grow to $320 or $30 right now, they would perhaps be valued realistically. I would also start selling call options on Facebook stocks too. Because I wouldn't feel sorry if they would keep going up to 340, 50 and 60 and if my call option would be exercised, because at that time I'd feel that Facebook is at $350, perhaps a little bit overvalued. So hopefully I explained to you how am I buying and stocks and selling options on them and in which cases I'm doing that. Again, I am selling put options when I feel that I would gladly buy stock at the price of my option in case they would be exercised. And I'm selling call options when I feel that stock price is realistically valued and when I feel that stock whose options I'm selling is not very volatile and I will be able to keep selling my options for a very long time period. But again, I will disclose to you on this channel completely how am I doing this and what are results of this strategy, and you will be able to see if it does make sense or not and how am I actually performing using it.